Hello and welcome to Talking Points. I'm Dave Kelly, Director of Advanced Media Production at Cal State Long Beach. Today we're going to be talking about recent economic trends and how they affect us globally, nationally, and here in California. My guest today is Dr. Robert Kleinhenz. Dr. Kleinhenz is the Chief Economist for the Los Angeles County Economic Development Corporation. Welcome, Robert, and thank you for joining us on Talking Points.
Thank you, my pleasure.
Well, let's start with the big picture because everyone has been hearing about China and the slowdown in China. We know that they had over the summer about a 30% collapse, if you want to use that word, in their stock market. They've also recently suggested that their growth rate is going to be about 6.9% for this year, which is below the target of 7%, just a little bit. But it's definitely down from previous years. And I know that that's caused some concern. We've heard a lot about it in the economic press. I've got a quote here from the Washington Post from just a few days ago, and this is the quote from the Post. It says, "It starts with the slowdown in China, which is already straining the global recovery. The world's second largest economy has lost its appetite for the raw materials that fueled its industrial boom, leaving the smaller countries that supplied it with resources stumbling in its wake. Slower growth abroad translates into weaker foreign currencies and a stronger U.S. dollar, which makes American goods harder to sell in the global marketplace." What about that?
Yeah, so, China is the second largest economy here on the globe. It had astounding rates of growth for decades as it was going through the industrialization process. A big part of that industrialization process was an export-oriented strategy. And in recent years, the country of China has gone through or begun to go through a transition from this export-oriented industrialization strategy to one that is more consumer spending driven. And that means they'll be less reliant on all sorts of things, including raw materials. And indeed, that does cause ripple effects throughout the global economy. Many other smaller economies around the globe are reliant on the Chinese market for their commodities and other products. So there will be some adjustment to take place over several years' time, I would expect.
People have used the word contagion to describe the fear of what may happen with the Chinese economy affecting the U.S. economy. Is there any real threat of contagion?
So as this story pointed out, we're all linked. So if the Chinese economy slows and that causes a ripple effect with all these other economies around the globe, our markets for our products that we sell abroad are going to be weaker. Chinese exports from the U.S. only make up about 1% of our GDP, and more generally, the trade component of the U.S. economy is among the smaller components of the U.S. economy. So we should be fairly insulated from the direct downside effects, but these reverberations that you mentioned, we have to be mindful of.
And there's another international issue involving what's referred to as the BRICS countries. BRICS is the acronym for Brazil, Russia, India, China, and South Africa. And there's concern that they may be developing an alternative basket of currencies, that's the phrase they use, to replace the US dollar as the world's reserve currency. First of all, maybe explain to our viewers what we mean by world's reserve currency, and if there is any real threat that the dollar will be replaced.
This situation happens from time to time. So the US dollar is known as the reserve currency around the globe, and what that means is that many foreign transactions are denominated in US dollars. It's also a currency that central banks literally keep in their vaults as a part of their hard reserves against deposits. So for decades, the US dollar has been the reserve currency. Well, why is that? It's because it is backed by a stable country, and the value of that currency itself is stable. And those are two things that, taken together, oftentimes are the determinants of whether or not a reserve currency will continue to be regarded as such, or if we'll lose credibility. It's all about the credibility of the currency and who's backing it, which is the government of the United States.
And what about this idea of a basket of alternative currencies? Is that going to happen? Are we going to see that happening?
Well, it could be that something like that will happen in the future, but do keep in mind you've got to generally look for some backing behind a reserve currency with a basket of currencies, I mean, I could imagine, for example, that maybe the euro and the pound and the dollar could become a basket-based reserve currency. I just don't know that it would necessarily transpire. So at least at this time, I don't think this is something that we necessarily need to contemplate as being inevitable.
Okay, and if we talk about the dollar becoming the world's reserve currency, which it certainly did over the last 50, 60 years or so, a lot of that was also tied to the fact that oil was based on the dollar, so we call it petrodollars. So if the world is still running primarily on oil, doesn't that secure the dollar's place as a world reserve currency?
Sure. I guess it's a good idea for us to think about the benefits that accrue to the U.S. By virtue of being the country that has the reserve currency on the globe. It does allow us to engage in things like deficit spending more so than we'd have to. It does allow us to run a trade deficit. And these are two things that have been a part of the economic landscape in the U.S. for decades. So the reserve currency in and of itself, that's an important role for the U.S. to play, but it also gives us some benefits vis-a-vis the rest of the world that we've taken advantage of, I would say, over the last few decades.
Well, let's talk about commodity prices, particularly oil, because that's the commodity that most people are aware of, although there are many others, certainly agricultural commodities and precious metals and that sort of thing. But in terms of oil, Long Beach has always been a very big oil town.
Right.
And has been so since 1921 when we discovered oil here. When we look at oil prices, when we go to the pump and we see the price going up or down, do we really put too much emphasis on that? And isn't oil and oil pricing much more stable and less causing of disruption than we maybe hear about on the news media?
Well, it's something that certainly catches the eye of consumers and businesses alike, and especially here in California. So a couple of things on this topic. You know, you don't have much else to do when you're watching that gas meter run when you're putting gas in your tank. So some people, I think, are paying attention and they're seeing that one week they're putting gas in the tank at $3 a gallon, next week it's $3.50. Here in California, one of the reasons for that is that we have a constrained supply. We have a limited number of refineries and a limited number of firms that are running those refineries. So that adds a little more volatility to our market. Of course, we have special gas here. All of these things make for a more volatile set of prices here in California than elsewhere around the country. And then on top of that, we have heavier taxes on our energy. So it does catch the eye of the consumer and the business. There's not a lot that we can really do about it at the present time. There's a study that just came out that showed that the oil producers in California may be colluding, but it's very difficult to verify.
It's always hard to prove those things.
Right.
Well, let's talk about the U.S. economy in general. We know that the unemployment rate has been coming down. We're now listing the official, what they refer to as the U3 unemployment rate at 5.1%. But the U6, which is perhaps a better measurement of the uncomfortable nature of employment in the country, is closer to 10%, or actually is at 10%. That means people that are working part-time jobs but would really prefer to have full-time work but can't find it, and those that are fully unemployed. So what about unemployment? We've seen it drop. It's now at about 7% here in LA County. Are we seeing unemployment starting to level out with the demand of jobs? And also, we're going to talk about labor participation. But first, what about the rate itself?
So the rate you refer to, the U3 rate, I call the headline rate of unemployment because that's what we hear about in the news as a rule. So at 5.1%, it's come down. It's about half what it was during the worst days of the recession. Typically the U6 rate, which adds in distressed workers, people who would like to work full-time but are working part-time and so on, that rate is usually about double the headline rate. So when the unemployment rate was almost 10%, the headline rate, the U6 rate, was about 20%. It's come down quite a bit, arguably. It's still a little bit on the high side, and maybe some people would say that it's more than a little bit on the high side, but it has improved over time. And other aspects of the labor market behind that headline rate have also improved.
What about this labor participation rate that we are hearing about a lot these days? We now have 94 million people nationally that are not participating in the labor force. That's a pretty big number.
Absolutely.
What does that mean? I know there's some trends such as baby boomers are turning 65 at the rate of 10,000 per day now. So one would think they would be easing into retirement. Is that what's happening?
So yes, the labor force participation rate's been declining for several years. In the immediate aftermath of the recession, the concern was that this was symptomatic of something structurally wrong with our labor market. As time has passed, we've taken the stance, analysts have sort of surmised that it's more an artifact of the demographics. And so you're right, the baby boomers are leaving the labor force as they hit retirement age. The interesting thing about that is it's not quite what you see on the surface. The labor force participation rate of older Americans is actually on the rise relative to historic standards. And at the same time, and this is what should be most concerning, young adult labor force participation rate is low and has been falling for the last few years. And I think that's partly still symptomatic of the long shadow of the Great Recession that's affected young adults in a lot of ways.
And when we talk about the national economy, we have this ongoing dialogue in our press about will they or won't they, and that's the Federal Reserve in terms of interest rates, and they've been held at near or at zero for several years now. And people keep saying, well, I think the next meeting they're going to raise it, and then they don't. And typically they cite the low labor participation rate we've been talking about. They talk about low inflation rate, and they also talk about the slow rate of wage growth, which is also a problem. So will they or won't they soon, and why would they if times are so uncertain?
So you're right. A more complete picture of the labor market goes beyond that headline rate of unemployment. It looks at labor force participation rate, about which we already spoke. It also looks at wage growth and the share of people who have full-time work. All of those indicators are moving in the right direction. Arguably, the Fed could raise rates now and over the next several quarters without doing much damage or slowing down the national economy all that much. So from the national perspective, from the U.S. perspective, it could do so. But it's also looking at what's happening around the globe, and we're looking at economic weakness among our trading partners. We already talked about small economies, emerging economies, and how they are struggling at this time. A higher Fed funds rate and a higher rate structure for the U.S. Is going to do damage to the credit markets in these other places. So the Fed could raise rates. I think it's holding off in light of the international picture, but if you want a prediction, I think it'll be this December.
All right. On that note, we're going to take a break. Stay with us. When we come back, we'll talk more specifically about California. Stay tuned.
Should your company buy or sell? Expand or not? Relocate? Or simply stay the same? If you'd like to examine past and present predictions, integrating finances and people, and make future predictions based on all that information, a career in economics is for you. You can become a part of this exciting field with a degree from Cal State Long Beach.
Welcome back to Talking Points. I'm Dave Kelly. My guest today is Dr. Robert Kleinhenz. Robert, before we left, you didn't completely answer that question about why the Fed would want to raise interest rates if we have a time of economic uncertainty. What would be the motivation for that?
Yeah, and it's a very good question. I should have mentioned it earlier. The reason that the Fed wants to do this in the first place, so keep in mind that raising interest rates is like putting the brakes on our economy. And the only reason the Fed would want to do that is, at the present time, is to move that particular policy tool to a more neutral position, such that if the economy should slow down or tip into recession at some point down the road, it has the capacity to actually use that tool to get the economy going again. Keep in mind that the Fed really has been the primary policymaker as far as economic policy is concerned over these last several years, given what's been happening on Capitol Hill. And so the Fed knows that it needs to move its Fed funds rate policy tool to neutral. It's going to take some time to do that, and it doesn't want to slow down the economy, but it needs to do that in order to position itself for what might be out there in the future.
So it's trying to create some breathing space, I guess, when that day comes.
Correct.
Okay, well, let's talk about California and specifically what's going on here in this state. We've actually had some good news lately in California. We have a budget that's not in deficit. It's actually in surplus this year, and spending for things like education actually ticked up a bit this year. So are we out of the woods yet?
Yeah, I think we are out of the woods in the sense that we have a revenue stream, partly voted upon and voted in, I should say, by the voters here in California, a revenue stream that's going to ensure that we have the capacity to cover these expenses. So by that I'm talking about the increase in the sales tax rate, increases in marginal tax rates. All of these were put into place just a few years ago. Keep in mind that there is a sunset on them, so we'll have to see whether or not these are kept or if they're dropped at some point in the time. But currently, we're doing pretty well with respect to our state budget.
Well, one of the vulnerable aspects of the state budget in California is the income stream and where it comes from in terms of state income taxes. Talk about where that vulnerable spot is.
Sure, and so the income tax is the largest source of revenues for the state of California, for the state itself as opposed to all of governments, including local. It's the biggest source. And the biggest concern with respect to the income taxes, we rely very heavily on high income earners for a big chunk of that. And those are individuals who see their revenues come in the form of stock returns and so on. And we know that the stock market's volatile, so that part of their income is volatile, and in turn, therefore, the income tax revenue stream is volatile. And so that's often been what's gotten the state of California into trouble. When the stock market plunges, those returns plunge and the tax proceeds plunge. So that's the sore spot, or I should say, the weak spot in the tax system.
All right, well, obviously we've seen some bright spots in the economy of late. What are those bright spots in the California economy?
Well, in an overall sense, we have seen that the unemployment rates come down. So it was 12.5% when it was at its worst. It's now just under 6%. Most importantly, I think, with respect to the unemployment rate in California, it's just about 1% higher than the nation's rate, which is 5.1, as we said earlier. It's normally about a 1.5% gap between the two. So for us to have closed that gap to something less than the long-term norm is very good. On top of that, the job growth in the state of California has been quite strong for the last 4 years. We've been adding jobs at a rate of about 3% year over year versus the U.S. at 2%. So arguably our state economy is firing on all cylinders and going faster than the nation's economy as a whole.
What are the key industries that are positioned to grow and prosper?
So we've seen growth in professional and business services. I just want to stop for a second and explain what that means. We're talking about architectural, engineering, legal services, IT consulting services, management consulting services, other types of engineering consulting services. And so there's been a lot of growth all around the state in that area. We've also seen continued growth in healthcare related employment, increases in leisure and hospitality, increases in construction. These are the areas where we've seen the most growth. And it's worth noting that in talking about all those industries, you're looking at industries that kind of cover the entire wage spectrum. So that's good.
So it's a good time to be a consultant in one of the technical fields, it sounds like.
Oh, indeed it is. You know, not only in the Silicon Valley, but also down here in Southern California, both Los Angeles County and Orange County, and of course down in San Diego. IT consulting and other kinds of information-based consulting are going gangbusters, not to mention the biomedical side of things. So there's a lot happening in these emerging industries these days. The job counts aren't quite as big as the news items that you hear about, though.
What about the entertainment industry? As we're taping this program, they're actually filming a major motion picture on our campus, not here in the studio, but elsewhere. What about the outlook for the entertainment industry? There's been a lot of talk over the last several years about runaway productions, meaning they run away from California and go to Canada and other states in the Southeast. What are we seeing in terms of trends there?
So the runaway production story really began in the early 2000s when a couple of states came up with incentives to try to lure production away from California. They were successful, and so we saw that employment in the industry fell pretty consistently starting in the early 2000s through the present. So the state of California has had a tax credit program in place for a few years. It revamped it last year with the idea being to encourage television production and also to give incentives for big feature films. In the past, it just made no sense given the incentive structure for those two areas of the entertainment industry to come back. So we're seeing an increase in television programming. That's good. The feature film programming isn't quite where we would like it to be, but I think that it's probably one of these things where we're going to have to, be patient. And I would think that in time, 2 or 3 years' time, we should be able to see a return of some of that activity. I don't think we're going to be, seeing job counts return to where they were back in 1999, which was the peak. But we should see some activity come back.
What about in the global logistics and international trade arena? Are we seeing growth there? Does that look pretty stable?
Also seeing not just growth in jobs, but also growth in real activity. So here in Southern California, as well as up in the Bay Area, there was a West Coast port strike earlier this year that diverted a lot of activity over to the East Coast, and it really stymied business here locally. And then on top of that, the ships that are making their call at these ports, the container ships, are about twice the size what they were even just 6 or 7 years ago. And so there was a congestion kind of issue that they needed to address. So many of these kinks have been worked out. We're about even with last year in terms of total port activity in Southern California, but we expect to see next year will be better. And in conjunction with that port activity, we've seen job counts rise.
So good news on a lot of fronts that we've been talking about now. So things are actually looking up. There are bright spots. We have to talk about something that's not so bright, and that is the rate of poverty in California. We are the largest state in the nation, so one would assume we would have a large percentage of the population in poverty as well. But we are actually, according to the Census Bureau's Supplemental Poverty Index of 2013, so that's a couple years ago, we were number one in the nation at 23.4% of our residents below the poverty level, supplemental poverty level, which is about a family of four, around $25,000 a year. So what does that say about our future prospects if we have almost a quarter of the state living below the quote-unquote livability index?
Sure, this is not an indicator where we want to be number one, clearly. And we really have a burden here because the cost of living in the state of California is high. It's particularly high in the metro areas where the vast majority of our population lives. And so we have a huge problem with respect to poverty that has been seemingly intractable. There are programs at the federal level as well as the state level to do things like subsidize housing for low-income households. But we have to look at some of the root causes. We have to consider over time, not just for the purpose of reducing poverty, but for the overall benefit of the economy, trying to get many of these individuals who are of working age to the point where they get the education, maybe complete a high school degree, and can become gainfully employed, and then help to move themselves and their households out of poverty.
So that may be one of the trouble spots that we really need to focus on.
Correct.
Okay, well, let's talk about another initiative that's been underway recently, and that is the drive to bring the 2024 Olympics to Los Angeles. Those of us that were around during the 1984 Olympics and had the chance to experience those know that that was really a fantastic demonstration of the I guess the collective spirit here in LA and the region around it to put on a great show and to actually make money doing so. But a lot of people are saying it's not going to be the same. It won't be the same kind of Olympics because we've lost a lot of that civic and corporate unity that we had then, and a lot of the Fortune 500 companies that were based here have now left the area. What do you think about that?
Well, I mean, you make a good point because you need to really have a lot of forces come together in order to make an Olympics a successful event for everybody involved. And Los Angeles did a great job in 1984. You look at things today, there will be a need for them for people, for businesses, for government officials to rally and work together. We have not seen a lot of that in Los Angeles for many years. You're right, we've lost many corporate headquarters. One of my concerns about Los Angeles County is that we don't really have a lot of large corporate civic leaders who can be champions for a cause, whether it be for the 2024 Olympics, which we all hope will come, or for other causes that around which we as residents of Los Angeles County and perhaps all of California should be rallying around. So it's a real cause for concern that we don't have that kind of leadership, or at least not visible at this time. It's be a great opportunity for people to step up.
We've only got about 30 seconds left in this segment. My last question to you is something that we'll need to get an answer in about 20 or 30 seconds, and that is, what about housing in California? And we are seeing a demographic shift with the baby boomers retiring or heading toward retirement, millennials coming up as the next big large population sector. Housing, is it going to be more like Manhattan, New York, not Manhattan Beach, and less like Mission Viejo?
I think that there are predictions that the millennials will be less inclined to have suburban-type lifestyles. I think the jury is out on that. When they get married, have a family, they may choose to move from the loft in downtown Los Angeles to someplace in Huntington Beach, or similarly from San Francisco to the East Bay. So I think we'll have to wait and see on that.
On that note, we'll have to come to a close. Thank you for being with us today.
Thanks, Dave.
And thank you for joining us on this edition of Talking Points. Join us soon for the next episode. Until then, I'm Dave Kelly. Have a nice day.